we want to say, again, thank you for being here. As the year turned and tax reform happened, we started fielding a lot of questions, and the questions kind of became repetitive because people had concerns. But the thing, this document right here, this is the first page of what is over a 1,000-page long document, the Tax Reforms and Jobs Act of 2017. It's a lot to distill, and we do our best at Madison Park to understand it all, but we also know that there are CPAs who dig deeper into the material, and we're glad to have Jim here to help us unpack it. But why does this matter? If you look at this wheel, when we look at financial planning at Madison Park Capital, we talk about one thing. Our name is not Madison Park Investment Advisors. It's not Madison Park Tax Advisors. It's not Madison Park Estate Advisors. It's Capital Advisors, because our job is to help grow your capital. And that can be done through a variety of means, whether it's the investments or the estate plan or tax. And your capital looks like business, tax, estate, investments, real estate, philanthropy, all these things. But in reality, what it really looks like is there's business taxes, there's charitable deductions, there's excise taxes and property taxes, there's capital gains taxes, there's estate taxes. So as you can see, tax really envelops every bit of a financial plan. And so as we thought about that, we decided, why don't we get together, start to distill some of the questions that you might have, and start to unpack what it is that you can try to do together with our help and with Jim's help to maximize your financial plan in light of the changes. So as you can see here, it's projected that 65% of people are going to save money, 30% are going to have no changes, and 5% are going to be left holding the bag and paying more. But no one is average. These numbers up here are averages. No one's average. Your situation is truly unique. Personal advice is, in our opinion, valuable and warranted. And one of the people that has served many of our clients very well, in addition to serving us as a business, is Jim Ramborger from Hagen, Kurth, and Perman in downtown Seattle. He is actually a fun CPA. We like to think. He's going to Disney World tomorrow, so hey. So with that, I will shut up and instead welcome up Jim to go through this. We'll interject back in with a couple planning opportunities in the middle. And feel free, as the presentation goes on, to raise your hand, ask questions. But also, if it's a question that you don't want to ask yourself but would like answered, feel free to write it on that notepad. We'll gather those up and we can answer those towards the end as well. So with that, Jim.
That was, I guess, something I have to live up to, a fun accountant. It's sort of an oxymoron, but I will do my best. I will say, too, that I could be in your shoes, that I'm not only a CPA, but I'm also a client of Madison Park Capital. So in a lot of ways, I could be sitting in the seat that you guys are sitting in tonight instead of presenting. So I have done this, and I've done this presentation before, and I've taken way over an hour. If I sit here and read through this thing, I can do it in about 20 minutes. So I am expecting and hoping for questions and things as I go through and talk about things to stop me at any point where we think that you may have a relevant question, and please feel free to ask. You're not interrupting me whatsoever. So my first thing is sort of a disclaimer. I don't know if this resonates for anybody. It's in my age bracket. All I'm saying is hopefully I won't be political tonight, right? I don't know, does anybody get this reference at all? Does anybody understand? It's the Muppet Show, so this is sort of my generation. So if I start veering off, I don't think I will, but I do not mean to be. I mean to sort of just talk about the facts about the tax law and nothing about politics. So next slide. So what we've got here that we're talking about tonight is the 2017 Tax Cuts and Jobs Act. I don't know, it's not necessarily relevant to you guys, but it is the most substantial tax reform since 1986. And I say not relevant, I mean, maybe you're not interested in that fact, but as a tax geek, I'm interested. It's also 1,079 pages to be exact. Andrew mentioned over 1,000. It was signed into law at the end of December the 22nd. and is generally effective December 31st. And I bring that up because there'll be some things that I'll talk about the effective date, and it does depend in some situations. There is substantial changes to all areas of taxation, but as this next point says, individual, estate, and pass-through provisions sunset after 2025. That means that this is primarily, or the initial focus was really on corporate tax reform, good, bad, or sideways. They threw along individual tax reform, small business tax reform as far as pass-throughs and sole proprietorships, and some estate things. But those all go away after the end of 2025 without further legislation. So as we're talking about some of these things, that's one thing to keep in mind. But you know, I guess I'm somewhat young, not as young as I used to be. I've seen a lot of changes. I've seen things get extended. The answer is always the same. This is the answer today. Things always change, and you just adapt and sort of go on when we run into those changes. There are some things that we don't have all answers for, and the IRS is asking CPAs and other people to give input on what are the areas where they want to see more information, or what are the topics that we want to see more information on first. So I will give you answers. I'll try to do my best to answer all questions. In some cases, I may not know what totally the exact detailed answer it is, but I'll give you my thoughts and tell you that in some cases, further information is coming. And the last thing, state conformity to changes. We don't have to deal with this in the state of Washington as much, but other people that have potentially live out of state or have state filings have to deal with these issues. For example, in the state of California, they're now trying to change property tax or income tax payments to charitable deductions that you get a credit for, just to get around these rules. So there's all sorts of things that states are going to have to deal with as far as the tax reform goes. All right.
Before we continue, one note, inside those folders are printouts of all the slides. So if that helps you in following along and taking notes, they're in there for you.
So we'll start at the very basic level, or one of the more simpler things here is just sort of changes. Changes to tax brackets. And I won't go through and run through every number. That would be very accountant-like for me. But I think the main thing that we can see is that overall, we've got changes in tax brackets. For instance, you know, we no longer have a 15% tax bracket. We've got a 12%. We no longer have 25. We have 22. And along with that, we have a lot of expansion of brackets. Well, it used to be that we had the 39.6 being the top bracket. Now it's 37. And it used to kick in for joint filers at 480,000. Now it doesn't kick in until 600,000. So I think that goes along with sort of Andrew's slide that says for most people, they'll save some money under the new tax law because there's just generally this expansion of tax brackets. Important though too, you guys are all invested with Madison Park Capital. One of the things that hasn't changed is dividend and capital gain rates. That's no different under the new law than it was the old law. We're still talking about a 15% bracket or a 20% or an 18.8% bracket or a 20% bracket or a 23.8% bracket under the new law for qualified dividends, long-term capital gains. And where you jump to going from 0 to 15 to 20 will not make any sense. These are random numbers. If I went back a slide, we don't need to do that. This number will tie to nothing. So it's just going to happen. These actually tie to old tax bracket numbers, but now under the new system, they're not going to tie. So randomly, you may jump from the 15 to the 20% tax bracket for capital gains. There has also been no change to the 3.8% NIT, the net investment income tax. I don't know, I'll just make a statement. This was put into place to help pay for the individual health insurance mandate. This is why they came out with this tax. Starting in 2019, there is no more individual insurance mandate. You don't have to have insurance. They did not get rid of the tax that went to fund this. I guess that is a somewhat political statement. I don't know, it's apolitical, but it's just a statement, right? So we have a tax that was put into place to fund something, and what to fund is sort of going away, but we still have it. And that is this 3.8%, for those of you that don't know, is the additional tax once you get around 250,000 of income, where your investment income gets hit with this additional tax. And so this hasn't changed, but one of the things that is potentially changing is it may be more prevalent. You may get hit harder by this tax under the new tax law. And the reason why, and we'll go over this and we'll talk about some of these things in more detail, is that there were changes to itemized deductions. And some of those itemized deductions you were allowed to take and offset your investment income for the purpose of calculating this tax. And those things would include investment fees and state income tax. And it's not that we're completely lost the state income tax, we're just limited. But investment fees are no longer deductible. My fee is no longer deductible. And when I say investment fees, I'm sorry, Jeff, Chris, and Andrew, and Dan, right? That means their fees are no longer deductible. Now, they've come up with more creative ways to do things and try to sort of ease that burden, but that's one of the realities in the new tax law. My fees as well, when somebody pays me to prepare a tax return. And we have state taxes, and when I even say state taxes, I mean all taxes limited to their deductibility to $10,000. So the impact of those things for the net investment income tax isn't that the net investment income tax has changed, but you're going to have further deductions and you may get hit harder from a personal standpoint. All right. This one is not fun to talk to about anybody. I don't particularly like to explain the alternative minimum tax, but that's one of the good things about the tax law is it's still around, although for corporations they completely did away with it, but for individuals and trusts it's still around, but they changed it. And I think that we'll see people get hit with it far less than we used to. And the reason why is that previously, if I was a married filing joint taxpayer, they gave me an I'll explain this. They gave me an $84,500 exclusion, right? Now they've jumped up to $109,400. Now, I should probably step back and explain that. The alternative minimum tax is a separate system for calculating potentially your tax liability. It's alternative in the sense that they take your regular tax liability, add some things back, and then at the bottom of that calculation, they give you this additional exclusion amount, which they subtract off. Well, now they give you a higher amount. And not only that, previously, if I was married filing joint, this amount that they gave me, this $84,500, it started to go away once my income, my taxable income was $160,900. Well, that's not a very big number for a lot of people. So that exclusion went away pretty quickly. Under the new tax law, that exclusion now doesn't start to go away for a married filing joint taxpayer until they have $1 million in income. So they haven't completely done away with the AMT. I can't say that people won't still get hit with the AMT, but I think it's far less likely to happen going forward. I think that's twofold. I think the other answer to why I think it's less likely is on the next slide, hopefully. Nope, it's not. I lied. It'll be coming up. But I will just tell you briefly, it's because I kind of mentioned and we're talking about net investment income tax, investment fees, tax preparation fees, state taxes. Those are some of the things that got added back to come up with AMT. Well, if they're not deductible anymore, I can't add them back. So I think that's the other reason why it's less likely. The other thing, and I think this is one of the areas we'll probably talk about more in planning and things that maybe you can think about doing is we always had this standard deduction that you could take, or you could itemize your deductions, meaning I could take my mortgage interest, my real estate taxes, my sales taxes, other items, and I could add them all up and I could deduct them, or I could just take what the IRS gave me. And I think for most people, you itemize your deductions. You took those basket of items and you took that as a deduction on your income tax return versus taking a standard deduction. And part of it is these standard deductions were relatively low. Like if you live in the state of Washington, you're probably paying a lot of real estate taxes, you have sales tax, you got your charitable contributions, you have a bunch of things, right? But now, the IRS said we're going to do away with a lot of those deductions, but what we are willing to do is to give you a higher standard deduction. And that higher standard deduction is basically, for most people, it's for every sort of tax bracket, it is about double what it was prior. So if I'm single, it used to be $6,300 or $6,350, now it's $12,000. If I'm married filing jointly, it was $12,700, now it's $24,000. There were extra provisions for people that were blind or over 65 where they got an additional amount. There's still an additional amount going forward. So for a lot of people, what this shift means is probably, potentially they're not going to itemize their deductions. They're going to just take the standard deduction. So in some ways, potentially we got tax simplification just because of changes, and this is one of those things that is probably causing that change. So now I can tell you what you can and can't do anymore. So go through those itemized deductions and those things that were on your return potentially and what it means going forward. Medical expenses, they actually made this more favorable. It was 7.5%. There was always a limitation that I could take my medical expenses and I could itemize them as a deduction as long as they exceeded a certain threshold of my income, my adjusted gross income. And a long time ago, it was 7.5. Actually, it wasn't that long ago. And then they jumped it up to 10. Now under the new tax law, they brought it back to 7.5. So that is, I think that's a good thing, but maybe not that beneficial to a lot of people. This one, I think, is going to be a killer and really affect a lot of people. Maybe if you got hit with AMT tax, it doesn't matter. All your taxes got added back. But under this new provision for state, local income taxes, sales taxes, and property taxes, right? You used to have no limitation on the amount you could deduct. I own multiple homes. I bought a new car. I paid sales tax on it. Look, I could go to on my personal return and I can deduct that. Now I can still deduct it, but I have to add all those up, and I'm limited to deducting $10,000. So if we live in the state of Washington and you own a home in King County, or even Snohomish County or Pierce County, and you factor in sales tax and other things, I think a lot of people are going to get hit pretty hard with this haircut. I think that's the reality of that provision. The second thing that's changed is home mortgage interest deductions. And this is one of those areas where it kind of matters on when the law got passed. It wasn't a provision that went into effect in 18, but actually started on 12/15/2017. If you took out a loan after that point, you were limited on the amount of loan that you could take out on a principal residence or a second residence and be able to deduct that loan. It used to be that you could have $1 million of indebtedness as long as that $1 million was used to purchase, remodel, refurbish, was basically used on your personal second residence, you could deduct the interest associated to that, up to $1 million. And I will add on, there's a caveat down below under the home equity line. But for all loans entered into after 12/15/2017, that limitation has been reduced. Now it's gone from $1 million down to $750,000. And so I've gotten a fair amount of questions about this. And for a lot of people, it may not make a difference because if I had a loan prior to that date, I'm grandfathered in. If it's $1 million, I get to keep that $1 million limitation. So you're grandfathered in, you don't need to worry about the $750,000 limitation. So it's for new home purchasers, people taking out new debt, they're the ones that have to worry about that limitation. The only thing I could say is, though, is at times we want to take money out, so we refinance and take cash out to maybe remodel our home, or interest rates drop, or there's something that just makes sense for you to refinance. I have not seen anything contrary. I believe under the new law, you refinance after that date, and those new limitations kick in. So I had $1 million of indebtedness. I went and refinanced that loan. I got a new loan with $1 million indebtedness. And if I kept that old loan, I could deduct all the interest. With this new loan, I cannot. I'm going to be limited to only taking 3/4 of that interest and being able to deduct it for tax purposes. So I get a fair amount of questions on that. Then there was always a piece where I could take out a home equity line of credit, and up to $100,000, no matter what I was using that money for, I could deduct that interest. You cannot do that anymore. So going forward, if you want to take out a home equity line of credit and use that money to pay off credit card debt, buy a car, do anything of a personal nature, you can't deduct that interest any longer, which is a change in the rules. So we used to say there was $1 million limitation, and the tax accountants would always really say, well, it's really 1.1. That's just a tax accountant being geeky. But now there isn't the possibility to do that. I will say this. You can take out a home equity line of credit and use it to remodel your home. And if you do that, that home equity line of credit falls under the $750,000. That's considered indebtedness that you're using to you're really using to remodel your home. It's attached to your home. It's directly connected, so there is no limitation. Yeah, Warren.
Just so I understand, so the home mortgage interest is not affected or is not impacted by the $10,000 limitation?
Not at all. The $10,000 limitation is just on taxes, nothing on interest. I mentioned that there's some areas where we need guidance, and one of the things that I need guidance on, and I don't know how to answer, so I'll just tell you, so don't ask me this question. Is I don't know. What if you have one loan for $500,000 and you decide to take out another loan for $400,000 and you use that money completely to remodel your home? I honestly couldn't tell you today how much of that interest you could deduct. And I think that's one of those areas where we need the IRS to step in and provide some more guidance. I'm sure there's going to be a calculation and more information on being able to do that. So. So in the regards to charitable contributions, there isn't really that substantial of a change. There's sort of two things that may impact you. One is the limitation was always that you could take any charitable contributions that you made, total them up, and as long as they were under 50% of your adjusted gross income, you could deduct them in that year. Well, the IRS, under the new tax law, will now be enforcing a 60% limitation. So we went up 10%. I don't know that that greatly increases too many things, but it is a step in a positive direction for taxpayers. From a negative standpoint, and this is Andrew, right, the nice Tyee club. I don't know how many people are Tyee members or have their season Husky tickets. You make that charitable contribution to have your right to have those tickets. Well, that's no longer a charitable.
I'm a Cougar fan now.
All right, so you, so your fee might be a little bit lower then, right? Yeah. So it used to be that when you paid for that fee to have that right to purchase those tickets and sit in those seats where you sat, there was a certain percentage that you could take as a charitable deduction. Well, you can no longer do that. So here in Pac-12, country, we're hurting, and SEC country, they're really hurting. But this will affect some people that are sort of the college sports fans. This one is big. I mentioned it already. The 2% miscellaneous itemized deductions are repealed. So no longer can you take unreimbursed employee expenses. No longer can you take someone like Mize fees. No longer can you take Madison Park Capital fees, with certain exceptions. Safe deposit box fees, hobby expenses, legal fees. Those are items you just can't deduct on your tax return anymore. So depending on what those total up to and what those amount to, that's potentially affects certain people more than other. But I think that's a big item that we'll see, and in the situations that I've looked at, that's generally where people get hurt as far as the new tax law not being a benefit to them. A lot of taxes are itemized, or these miscellaneous itemized deductions. One of the things, though, that I think was a good thing was, I don't know if people, when they're filing their tax returns, even realize this, is sometimes you itemize all these things on your return, you're taking a deduction for them, and you total them up, and you get $50,000, and then you look at the amount you're allowed to deduct, and it's only $30,000. Well, that's because there was a congressman from Ohio, I think it was Donald J. Pease, that implemented this Pease limitation. And that Pease limitation basically started reducing your itemized deductions, 3% once you got past a certain income threshold, up to 80% of your deductions. So that was a negative thing, and under the new tax law, we've done away with that. I say that that's a good thing going forward, but when I also can't deduct as much as I used to be able to for maybe interest, taxes, and itemized deductions, maybe that isn't as helpful as I'd like it to be, but it is an item that has changed. And there's no, if you have investment interest, there's no change. That's still deductible for tax purposes.
All right, so here's where Jim and I are going to trade seats for a second. If you're standing in the back, there are some seats available. Feel free to file in or keep standing if you prefer. But what Jim has talked about here is a topic that has come up quite often, this idea of the standard deduction is increased to $24,000 if you're married filing jointly, $12,000 if you're an individual. And you're looking at your situation saying, all these taxes I'm paying, all these charitable deductions I'm paying, suddenly provide no marginal benefit to me as a taxpayer. We don't all give money because we just want a tax break. Most people give because they're generous people. They don't pay their taxes because they're generous people, but they pay them nonetheless. And so they're looking at it saying, well, what do I do about this? I'm still making these contributions. I'm still paying these taxes. How can I maximize that opportunity? And so what we've identified, and we've talked to quite a few clients about it, and we'll walk you through the example here, is a way to use accelerated deductions, giving, or tax payments in order to maximize your opportunity to save under the new regulations. So let's say, for example, you give away $1,000 a month, $12,000 a year. You have deductible expenses that are capped at $10,000. So your property taxes are $9,000, your sales taxes are $2,000. That makes $11,000, but you're capped at $10,000. So your total, and you have no other itemized deductions because, as Jim just explained, most of them got wiped off the possibility list. So your total itemized deduction would be $22,000. In this case, you're going to choose to take your married filing jointly. You're going to choose to take your standard deduction, $24,000. You're going to get no marginal benefit from having this. And we're going to assume you're kind of right in the middle with the marginal tax rate at 22%. Your capital gains rate is 15%. We looked at that earlier. And by the way, you own some Microsoft stock that you paid $20,000 to obtain. It's worth $45,000 now. If you were to sell it, you get a nice gain, but you'd also owe $3,750 in taxes. So let's walk through this. If you, instead of giving that money directly to the charity or charities that you've preferred to give to in years past, instead gave to what's called a donor advised fund. And if you look in your folder, this same example is printed out for you. And if you ever wanted to run your numbers through, it's an Excel spreadsheet that we set up. We can easily plug your numbers in and see what the impact is. But let's say that you use a donor advised fund. And all that is, it's a charitable entity where you give, you have a fund in your name. You give to that. It's a charitable organization, a 501c3. You can take a deduction when you give to it. And then that money is in an account in your name that you can direct grants out of. And so instead of giving directly to the Boys and Girls Club, you funnel it through the donor advised fund. You can give it out in the schedule that you still prefer. They're not just going to get a big chunk of $36,000 and then they're not going to hear from you for 2 years. So you give $36,000 to this charitable, to your donor advised fund. You take your other deductible expenses. Your itemized deduction is $46. In year 2, it's $10, and it's $10. In this case, you're going to choose here to itemize, and in the next 2 years, you're going to take your standard deduction. Fairly straightforward. Now let's look at, if you did it as before, you give 12, 12, 12, you deduct 10, 10, 10, but every year you're going to choose 24, 24, and 24. Well, if you compare those two numbers, they're two sets of numbers, what you see is under the first one, your total deductions are $94,000 over the course of those 3 years. Your total giving is $36,000. If you did it as you've done in the past, which many of us have been kind of preconditioned to do, your total deductions are $72,000 and your giving is exactly the same. I don't know about you, but to me this looks like a much more attractive situation, because when you factor in the savings and tax from this together with the savings from, I kind of skipped one point. Instead of giving cash for that $36,000, if you gave that Microsoft stock, you get that a tax savings there in addition to the tax savings from here, and suddenly you've done nothing different in terms of your impact, in terms of your giving. There's nothing different in your tax payments, but you've saved yourself in 3 years over $8,500. A pretty simple and straightforward way, easy to implement, something that we can walk you through without much problem at all, and something that's very attractive. And it's especially attractive to those who they may be retired and if they've paid off their house already, or they're renting, they don't have any mortgage interest deduction to take. And if you don't own the home, you also don't have property taxes. So in this case, giving, especially appreciated assets through that donor advised fund, makes a ton of sense for a lot of people who are charitably inclined. So again, if you look in your slide or in your folders, there's an example. This same example is printed out and laid out and kind of gives a little bit more detail on the justification. So, yeah.
So what you're saying then is that that $36,000 that you've set aside can then be divvied up over the next 3 years?
Exactly.
So you don't give it all at once?
Yeah, so you give to a donor advised fund. So Fidelity has them, Schwab has them, the National Christian Foundation has them, Vanguard has them. They're easy to access, they're easy to set up. The money goes in, say 36,000, whatever number it is, and then you set up a schedule to give out of that. You could give a lump sum right away, or you could set up to give that $1,000 a month that you were giving previously. You're just doing it through your donor advised fund rather than through your checkbook.
Do you know if matching still applies when it comes out of a
Matching can apply, yes. You're still giving to a registered 501c3. So they would likely match when you give into the donor advised fund. And then the only issue potentially there is if it's capped on how much they will match in a year, you might run into an issue there. You'd have to check with your employer on that one.
Is there anything magical about your 3-year period, or is that just for your example?
There's nothing magical about it. It depends on your own situation and what if you're giving appreciated assets, kind of what you have to tap into. 3 years tends to be a number that most people can swallow, rather than giving this big 5 or 6 year chunk out of their assets. And because once you give to that donor advised fund, you can't take it back. It's a gift, just as if you gave it to the Boys and Girls Club. Now, if you're retired and age 70 and a half or over, you have an additional option called a qualified charitable distribution. So you probably all heard, even if you're not retired, there's a thing called a required minimum distribution from an IRA. Once you hit 70 and a half, if you have a traditional IRA, a SEP IRA, a traditional 401k, you have to take your money out of that account under a prescribed formula from the IRS. There's no getting around it. But what you can do, and when you take that, it's ordinary income. It's taxed as ordinary income using those same brackets we looked at before. And so it can be pretty punitive depending on your tax bracket. Well, if you decide that you want to give, but you want to do it more efficiently, you can give directly from your IRA. Let's say your RMD is $10,000. And again, there's a flyer in your, or a handout in your folder if you want to look at this example. Under the qualified charitable distribution, you're taking $80,000, you're able to, sorry, I'm a little lost on my own example here. But you can take the money directly out of your IRA. It has to go directly to the organization that you're giving it to. In that case, it never hits your tax return as income. So you don't have to pay taxes on it. The nice thing then is you can take this big standard deduction. Once you're over 60 and a half, you get 24,000, or 65, sorry. You get 24,000 plus you get that $1,300 per person that Jim mentioned earlier. And so this can be a significant, you're doing the exact same thing as you were before, but you're saving $1,200 simply by giving directly from your IRA rather than first taking it as cash and then giving it from there. You're accomplishing the exact same goal, but you're saving money in doing so. And this was attractive before. It's more attractive now with the new arrangements under the standard deductions of the Tax Reform Act. So with that, I think Jim is going to rejoin the conversation.
Yeah, I think Andrew is right. Like these are both of those ideas are not something that was new because of this tax law, but I think they're just more attractive because of the realities of the tax law. Personally, I will say I want to talk about a couple things on the donor advised fund. I find a benefit to them in a kind of couple ways. One, I don't know if people decide to be somewhat generous to a lot of organizations or just a little bit generous, and then all of a sudden you're on their list for life. And they start spending more money on soliciting you than you ever gave them as a charitable contribution, right? So I like donor advised funds because it's from a fund that's with Fidelity or somebody. My address, my name can be associated with it if I choose to be, but I can basically give anonymously, and so I don't get that solicitations back. And so from my standpoint, like I enjoy the fact that if I give $50 to, and I think it's a good organization, so don't get me wrong, but the Seattle Gospel Mission, I don't get 50 letters in response thanking me and asking me for more money. So I think there's a benefit to those from that regard as well. And you don't have to do something different in your giving. If you go to church and you give $1,000 every month to church, if you set up a fund, you can give $1,000 to church through your charitable fund. So you don't have to change your giving patterns just because you open up a donor advised fund, or you don't have to do something new and novel when it comes to gifting. You can sort of keep your old habits. So from that standpoint, I think they make a lot of sense. The only potential drawback is there's always fees associated with that account. And depending on who you have that account with, that fee is different. But I think almost anybody is under 1%. I don't know. In general, yeah. So a couple of other things that are changed. I mentioned AMT is still around, but it's reduced because of other things. But again, it probably would be less likely to hit you going forward anyway, because one of the add backs previously was personal exemptions. Well, you don't get personal exemptions anymore. So I'm not benefited by having 10 kids, at least from getting 10 personal exemptions. Now, what they've done to sort of counteract that is, and maybe I'll say some things that are a little tongue-in-cheek, and I don't mean to, but we've always had like these child credits, child tax care credits, and there's people that benefit from them, and there's a lot of people that would hope they would benefit from them and never would because their income was what I would say in this geographic area was pretty middle class, and they basically their income was too high to really get a benefit of this child tax credit. And I think I can say that because here before we were really looking at $1,000 child tax credit, and at points they had bumped them up to $1,500, but we always had these phase outs. So I had a kid, but and I'm married filing jointly. I made over $110,000. I got nothing. Or I'm single and I made over $55,000. I got nothing. I think most people that are working, or two spouses that are working in this geographic region, like I said, I don't think they got anything from this. But we no longer have personal exemptions. So what we've done under the new tax law is we've beefed up this credit. And we've jumped it up. So now it's $2,000. And like I said, it was $1,000. And not only that, $1,400 of it can be refundable, meaning I could have zero tax liability and the IRS is going to send me a check for $1,400 even though I paid nothing yet. And the nice thing is now we've significantly increased the threshold and the amount of income somebody can have and still get benefit. So, you know, we can have a marrying filing joint taxpayer with $400,000 of income or a single person with $200,000, and now all of a sudden they're actually getting benefit of these credits. So I really, you know, I don't know that it's that impactful, but I enjoy the fact that this has actually been increased and doing something to benefit people. Yes, Andrew.
And that 400,000 is taxable income or adjusted gross income?
It is actually adjusted gross income. I'm sorry, I misspoke there. And not only that, I will say this, that's all right. My in-laws live with me. They live downstairs. We got a mother-in-law basement. I could potentially claim them as a dependent. And if I can justifiably claim them, I can get $500 for both my mother-in-law and my father-in-law. The best deal I got the whole time. Well, no, I got a beautiful wife and a beautiful family. And that's the best part of it. But I can get, the IRS could give me some money back and also give me a little bit of benefit for having those people live in my basement. So if you've got people that you support that aren't your kids, you can instead of the $2,000, you can get up to $500 for each one of those persons. So I think there's a benefit there. So as we talk about other deductions and other items repealed or modified, if you moved for purposes of a job, you used to be able to deduct your moving expenses. And if your employer paid for those moving expenses, they could give them to you as a tax-free benefit. That's changed. Under the new law, no longer possible. Can't deduct them, employer can't pay for them on a tax-free basis. Hopefully nobody here has to deal with this. Under the old law, you could, if you were paying alimony, you could deduct it. And if you were receiving alimony, you had to take it into income. For divorces, so this is grandfathered in, so we're just talking about new divorces executed after 12/31/18. If you have to pay alimony, you can no longer deduct it for tax purposes. So that's a bad thing. If you're receiving it, you no longer have to claim it as income. That's a good thing. So just a change in the tax law there. As I mentioned, starting in 2019, you no longer have to have, I guess the federal government is no longer penalizing you for not having health insurance, starting in 2019. They're getting a little bit more esoteric, but if you had a casualty loss, it used to be able, there was a lot of things that would qualify there. It could be theft, it could be, I don't know, a tree falling on your house. Now you can only claim a casualty loss if it's a federally declared disaster. So they changed that rule. And I think this is a little bit more obscure too, but as anybody who's ever had this happen where they've had kids with unearned income, and they had the kid, you thought, well, I could shift some of my income to my kids, they could pay the taxes. Well, at some point, that income was actually taxed at your rate under the kiddie tax rules. And that's no different, but now what they've done is just simplified it, and you just go and look at the trust tax rates to be able to do that calculation. Other items actually retained, student loan interest, although a lot of people don't get the benefit, that phases out pretty quickly. For educators, teachers, there's a $250 deduction above the line. That's still there. And I think there was a fair amount of people that asked me questions about this. And I think in some of the proposals, they thought that potentially they would take away the exclusion for selling your home and being able to exclude up to $250,000 or $500,000. They did not take that out of the tax law. That is still there. So if you lived in the house for 2 of the last 5 years as your principal residence, you still have that gain exclusion. So, all right, next slide. Other provisions. We can still, I don't know, have you guys, Andrew, you've worked with some people on doing Roth IRA conversions. So taking an IRA that I have and converting some of it to a Roth or all of it, You pay tax on that conversion. You can still do that, but it used to be if you didn't like the results. So if I did that in 2017 and I didn't like the results when I went to do my 2017 tax return, I had up until the time I actually filed my tax return to undo that conversion. So if I extended my return, I had all the way out to October 15th to actually take that money back that I did the conversion with and put it back in my IRA, and I don't have to pick it up in income. So that was nice from a planning standpoint, because if somebody asked me at the end of the year, hey, should I do this? Does it make sense? I'm like, well, there's no harm. Let's just do it, and if we didn't like it, we'll take it back. Now if you do it, you're committed. No more rolling it back after you do it. So jump in 2 feet and deal with the results, and hopefully do some good planning up in advance. I should say that. And there's sort of a more obscure extension of rollover period for plan loans for 401ks. I'm happy to answer questions if somebody thinks that's of interest, or if that's of interest of somebody, but a little bit more obscure. Some things different in education planning. Now I can have a 529 plan, and every year I can take up to $10,000 out of that account per child and use it not for college, but I can use it for private tuition for elementary, junior high, and high school. So for your primary education. Does it make sense? I think you have to look at the situation for each individual person to say, does that make sense? I don't know. I think about it and think, all right, 529 plans, are kind of intended for college, but maybe I'm not going to use all the funds for my kids' college, so maybe I do want to take some money out. This is one of those areas where maybe you live in a state, one of these state conformity things, where if you file your state tax return, if you put money into a 529 plan, you don't get any sort of federal income tax deduction. But some states give you a deduction. So for instance, I could live in Indiana, put $10,000 through an account, get a state income tax deduction, and then take the money out the next day and pay for my tuition. I thought, man, that is great. I get a tax deduction for paying for my kids' private school. So those are issues that states are grappling with, and where there's conformity issues. We don't have to deal with it so much in the state of Washington, but you do have the opportunity to take money out if you want of a 529 plan to pay for primary education. A little bit more obscure, 529 plans and ABLE accounts. We'll skip that. Okay. If you die, you're no longer taxed on your student loan forgiveness. That was nice. Yeah. Probably the least of your worries at that point. The college credits, those have not changed. And there's also an alternative to the college tax credits. There's a deduction that you can take. Not part of this legislation, but there was another tax legislation that was passed, the extenders legislation, and that's retained as well. So those rules are just the same. Just wanted to highlight that. All right, I'll be quick on these, but stop me if I'm going too fast. Carried interest. I could be an investment fund manager, get some sort of preferred return, and be able to take the whole amount as a long-term capital gain versus some sort of form of income. They've just changed the rules to make that a 3-year waiting period. If somebody in this room has either RSUs or some sort of stock grants or potentially ISOs, and it's from a private company, not publicly traded, but a private company, there is a new code section, 83I, that actually allows you to make an election and upon vesting, defer the taxation on that for up to 5 years. But I think this will be a little bit more obscure because these are private companies and not publicly traded companies. Not that I don't have clients that might affect, but I think it's less likely to affect people. But anyway, I think that's a good thing. If that happens, it makes a lot of sense to use that. The downside is there is some, but fairly minimal. Like-kind exchanges, if you're a real estate investor, the rules haven't changed, but like-kind exchanges used to also work for other business assets or other things, other investments. Never stock, but other investments. Now going forward, the only thing you can use it for is real estate. That's it. So no cryptocurrencies, but you could for 2017.
And commercial real estate. Insurance contracts?
Sure, nope, no insurance contracts. So I deal with a fair amount of clients that have are commercial fishers, commercial fishermen, and some of those people have quota that they're given, which gives them a certain allocation of fish they can catch. And previously, they could sell one and then buy a different version of quota, and it could be different species and similar to insurance contracts. Like it was something intangible, but you can no longer do that. Oh, but I guess you are saying that there is, let me step back, because there's 1031 that has to do with like-kind exchanges. Insurance contracts usually fall under 1033. No change there. This isn't, well, this is partly the new tax act stuff that it's hitting, and some of this is just changes in the tax law. As we go into 2018, from an estate, trust, and gifting standpoint, you can now give up to $15,000 per giftee per person. The federal tax exemption rate now is $11,200,000, and that is per person. So if you're thinking about a married couple and we're thinking about portability, the ability to shift unused exemption from one individual to the next, we're really talking about over $22 million that you can potentially transfer for a married couple before ever having the federal estate tax hit them. That's,
They used to be $1 million, right?
it used to be a low $1 million, but when I started, I've been doing this for about 15 years, it was $1 million. So we're now up to $22 million. Now, I'm going to go back and say what I said before. These all sunsets at the end of 2025. So if you're going to think about runoff and go talk to your really good estate planner and to change your will and change your whole estate plan, do know that at the end of that period, we don't know what we're going to have. So, but we've always been a little bit up in the air of what that exemption is going to be. We're at $1 million, we're at $5 million, we're at $10 million. We're all over the place.
Gary Cohn was quoted yesterday as saying that the piece of unfinished business that he wished they had done was to make the individual changes permanent.
Permanent, yeah.
So he said that they still want to work on that.
So, and I think, I'll get my crystal ball out, I think as we get to 2025, I think especially when we're talking about popular provisions of the tax law changes, I think we'll see some things get extended. Now, I can't say that for sure, don't quote me on it. Don't put that on your return. I heard this guy at a seminar say I could do this and this wouldn't change, so this is why I did it. That doesn't work, but I think there's a good chance. So I'm going to, so I said that, right? And I put this other piece not because it has anything to do with federal taxes, but we live in Washington State, right? So in Washington State, we still have an estate tax. And that threshold is, for 2018, is $2,193,000. So you can say, great, I'm never going to be at over $22 million as a married couple, but a lot of us are going to be over this threshold. So we still have planning to do, and I'm not going to, that's something that just hasn't changed. So a lot of what you're going to do from an estate plan is maybe not think about this, but think about this. Now, the numbers aren't as great, right? Theoretically, in the past, and maybe even some people going forward, you get hit by 60% if you think both Fed and Washington. But now we're thinking more about just Washington and 10 to 20%. And there's things that you can do to avoid this, or at least mitigate the consequences, I should say. Some things are hard to avoid unless you want to move out of state.
The interesting thing is there's no look back either on that. So if you had a $5 million estate, you could gift away $3 million.
That's right.
Get under that $2 million, $2 million and change threshold, and die the next day. You're not subject to Washington State estate tax either.
And that's part of the planning you can do. I had a partner in my office. He wrote an article for the Puget Sound Business Journal, and his basic answer was move out of the state. Now, that isn't my answer per se, but that is an answer, right? Houston, Texas is nice. No income tax there, no estate taxes, places in Nevada. But there is one of the big planning opportunities is there is no gifting look back. There is no, you can, not that we ever hope that we get there, but you can be on your deathbed and start making gifts for Washington State estate tax purposes. And at the bottom of that page, sorry, there was, with the change in federal income tax rates, there was changes to the trust rates. They're still bad. I don't like to have income in trusts for the most part, but they've just changed with the individual tax rates. So some of the things that we've been thinking about, and some of the things we've been talking about here, so as we're thinking about the new tax law and what are things that we could be doing or thinking, I like the idea of charitable giving. I like the idea of bunching deductions, thinking about things over a multi-year period versus just 1 year. Investment expenses, I think the shift was, hey, we used to tell you, pay your IRA fees with after-tax money so you can deduct it on your return. Hey, now pay it out of your IRA so we don't have a limitation. So there's things to do differently. With changes with the estate rules, there's a lot of opportunities for gift planning and other things. For people that have that possibility of working for a private company and getting some sort of stock options, there's things that we can do there. This was something that was really for me as the tax preparer, thinking about the clients that I work with. A lot of people make estimated tax payments, and a lot of people make those tax payments based on what they made the prior year. 100%, 110%. So I'm going to make that payment, and I know I'm going to be okay because I've met the IRS safe harbor threshold. Well, as I think about that, I also assume that, hey, I'm getting paid the same. My withholding should be about the same. Well, for 2018, your withholding is not going to be the same. There's new tax tables out. They're withholding less. So I think if you're making estimated tax payments and you're also employed and somebody that has withholding taken out of their paycheck and that's factored into your calculations, I think you need to take a good look at that and really see, are you meeting your targets to keep yourself out of a penalty situation when it comes to individual, income tax. So those are some things that I've kind of thought about as far as planning.
So here that kind of wraps up the presentation part of it, but we asked you, if you filled out the Google form to register, to send us some questions ahead of time. A few of you took that opportunity. So I threw a few up here just to prime the pump. We've got about 5 minutes or so before we finish the individual side. We grab some drinks and have private conversations with Jim or the rest of us. And then we'll do the business side of it after that. But we'll take about 5 minutes or so. Answer some of these questions in addition to questions you can raise your hand and ask, or if you don't want to ask it out loud, hand us the piece of paper and we'll read it out on your behalf.
So do you want me to answer these questions first or take questions? Yeah. All right.
Let's take however you want to do it.
We'll take questions. Anybody has any questions they'd like to ask that they were saving up? All right. Well, I've got 5 in front of me here. What are the new changes around deductions, including charitable giving? I think we went over a lot of those changes. Charitable giving, the changes really is going for a 50% to a 60% AGI limitation.
One kicker on that, that's for cash contributions.
Yep.
If it's a real asset you're giving, it stays 50%. It's a kind of a quirky little rule.
Yeah, it's quirky one. And capital gain assets are 30%. So stock is even limited further. And then the idea that, if it's for ticket preferences or other things through my college that I'm supporting, I can no longer deduct that. How will the new 20% deduction work for service businesses? I'll cover that next. We're going to talk about more of the business things, and that gets pretty technical. What are the new tax law implications for capital gains associated with LLC income? We kind of talked about that in the sense that capital gain income has not changed. Whether it be from an LLC or flowing through from an S corporation or a straight partnership or on my individual return, if I have capital gain income that I have to pay tax on, that has not changed under these new rules. I'm still looking at 15 18.8 or 23.8% that I have to pay tax on, potentially 20, but one of those tax brackets.
On that one, there's a lot of talk about the pass-through income and all this.
Yeah.
Could you kind of talk about what that is and how?
So I've got a 10-page handout and multiple slides talking about that, and I don't mean to, like, I'm not a sales guy. I'm an accountant. I didn't take many marketing classes. I don't like to prime something, but that's really, I really meant to go into that as part of the second part of the after the break, because I think that's one of the key things of the business provisions that'll affect anybody with business or investment income potentially coming through from a partnership. Traditional IRA to Roth IRA conversion, you can still do it. No changes except for the fact that you can't look back and undo what you wanted to do, undo what you did after looking at the tax consequences.
Is there any limit on how much you can do per year? Or?
No, if you want to convert it, you can do as much as you want,
So
much as a little.
If you're a small business owner and you have a net loss in that given year, that can provide a really good opportunity to convert and not pay any taxes on the conversion.
Yeah, I think that's probably one of the things that I talked about when I have clients that are maybe in an off year income-wise for multiple reasons is, okay, well, let's not lose this low year. Let's take advantage and maybe do some conversions of retirement amounts to a Roth. Same question for capital gains associated with sale of personal residence and if reinvesting in new property defers any of that gain. Rules about selling personal residences hasn't changed. Before I was practicing, so prior to 15 years ago, I don't know when it was, you used to have, if you wanted to defer a gain when you sold your personal residence, you had to reinvest it in a new residence. That rule has not been around for a long time. You can just sell it, your house, do whatever you want with the proceeds. You get the $250,000 or $500,000 of gain exclusion if you meet the 2 out of 5 rules, and no requirement to do anything else beyond that.
How about basis of your house that you started with, and over the years you put on a new roof and you remodeled? How does that all work in determining what that $500,000 is?
So those would all be added back to your cost basis. So you paid $300,000 for it many years ago. At some point you put on a new roof, it cost you $10,000. Add $10,000, you're now at $310,000. At some point you did a major remodel of that house, redid the kitchen, the basement, you did all this stuff, it cost you $200,000. Add that, now I'm up to $510,000. Those are all things that go into your cost basis that determine what your overall gain is once you sell it. So
No depreciation associated with those things?
if it's a personal residence, you would have never depreciated it, no reduction.
But, but your purchase price also isn't adjusted for inflation. So if you bought it 30 years ago for $80,000, that's your cost basis.
You had the built-in depreciation there. Yeah. I get the question sometimes from people, and I don't mean to go into the minutia, is, well, okay, at one point I did $1,000 to replace a window. Is that enough? Now we're getting into gray areas, right? At a certain level, you'd say something is a repair and something was more of an improvement. And that is, I could say there's certain things that are certainly repairs and definitely should be called a repair, and there's certain things that should definitely be called improvement, and then there's going to be a bucket in the middle. It's a conversation.
The hard part is if you've lived in your house for 30 years, and trying to go back over multiple additions and remodels and so on, trying to figure out, technically you're supposed to have the receipts.
You're supposed to have the receipts.
Like anybody who keeps receipts for 30 years.
I had a client that did that. He just... And I was going to say, I had a client that did it this year. He just wasn't nice enough to add the receipts up before he gave them to me. So I got the shoebox. Yeah.
All right. Once again, thank you. Enjoy the wine, enjoy the food. Thanks to Jim.